Hello, Justin.
Richard, how you doing this afternoon on this Wednesday?
I'm doing great, thanks. How are you doing?
Great. Despite all the craziness that's happening everywhere around us, keeping my head about me.
That's how you win.
That's right.
And yeah, it is a very interesting time. And it's a time that makes me even more excited about what we're doing.
Yeah.
I mean, excited is sort of an awful word to use in such a terrible time. But look, this happens in the world. Mm-hmm. And people need to know how to make decisions
amongst the uncertainty
all the time, right?
Yeah.
And I've been looking into the work of Harry Markowitz. Okay, so he's the guy who first created modern portfolio theory with a paper back in 1952. Okay, 1952, he publishes this paper, Portfolio Construction, in the Journal of Finance. And that was 70 years ago.
It's crazy. 70 years ago.
70 years ago. And meanwhile, Markowitz's work is table stakes for professional and institutional investors. And it's completely unknown, like virtually unknown in the retail world.
I don't understand how such an important piece of financial literature, if you want to call it that, the paper, and it's only a 14-page paper. You can download it. It's a PDF. It's his original thing that he put out this month. I don't understand how such a seminal work, something that is so cornerstone to success in portfolio management, has basically remained completely unknown by the retail public for 70 years.
Yeah. Well, I've got some ideas, but that's not what we're here to talk about today.
That's right.
But why I'm bringing it up, besides just the remarkableness of it, I mean, It was literally March of 1952, right? And here we are in March of 2022, right? So it is profound, but I think it really explains a lot about what's going on in markets today. Mm-hmm. Okay? And so to help everybody understand that, and to even help you understand that, I've got this picture here of an event that I know you'll remember, which was Hurricane Irma.
Yep, I remember driving at 90 miles an hour up I-75 trying to get out of the state.
There you go. So this was March 8th, 2 days before Irma hit Florida. Yep. And this is a so-called spaghetti plot showing, possible paths of where Hurricane Irma might go. Okay? And, so what you see is that over time, the possible paths kind of spread out more, right? Yep. They're more tightly clustered down here, but they spread out more as you go further out in time. Yep. So what Markowitz called his theory originally was mean variance analysis. So what's the mean, or the middle, right? And what's the variance? What's the range of possible outcomes? Yep. Okay? Obviously, in the weather, in markets, there's a lot of different things that can influence the range of possible outcomes. And the really amazing thing that Markowitz illuminated for all investors except for retail investors is that the amount of variance, the width of the possible outcomes, has a cost to it. Okay? As there are more and more possible outcomes, as we're less able to predict the future, right? As there are more paths that the future can unfold, each individual path gets priced less, is less valuable. Okay? So this is exactly what's happened in markets with, for example, Ukraine.
Yep.
Right? And there have been a bunch of issues in markets since the beginning of the year: inflation, energy, right?
Mm-hmm.
Ukraine.
Yep. The Fed decisions on interest rates looming, all kinds of things.
All kinds of things have created, right? Fed tightening, all kinds of things have raised the level of uncertainty.
Mm-hmm.
It's increased the number of possible paths in which market futures might unfold.
Right.
And not surprisingly, we've seen prices decline in the face of that uncertainty.
Interesting.
Okay?
Yeah.
So even though the ultimate path of markets, may not have shifted that much off of the mean, just the fact that the spectrum of possible outcomes is widening has a negative impact on price.
Yep.
So, we saw that with the Ukraine, the Russian buildup before the invasion, right? It was like a wide number of possible outcomes. And then when the invasion launched, there was like a relief rally for a week or so as markets started to say, okay, that's awful. Prices have rightfully been reduced, but at least we sort of see a likely outcome here, which is that Russia is going to come in and quickly achieve their objectives. It won't be great, but it will at least be resolved.
Right. The market doesn't really care as much about right or wrong as it cares about certain or uncertain.
Yes, exactly. Right. And this is the work of Markowitz.
Yep.
That's what he showed 70 years ago, that certain or uncertain, like that level of uncertainty matters.
Yep.
Right. But then as human beings, we're wired up not to think about the range of uncertainties, right? We're wired up to like, give me an answer, And so we bite on these narratives, and the media is in the business of giving us false certainties, selling us, false certainties. The market's in the business, or certain elements of the markets are in the business of selling us false certainties.
Yep.
And us buying them hook, line, and sinker.
Yep.
But this is what smart investors do, right? Smart investors know, and professional investors know that the risk. This is mathematical risk. Okay.
Absolutely.
We didn't know it was going to be Ukraine, right?
Right.
We can talk about whether or not you could have predicted that there was going to be increasing uncertainty in the markets. That's not what I'm talking about. I'm talking about, a dispersion of possible outcomes, a greater range of possible outcomes. And so, and then the Ukrainians were put up a more vigorous resistance than the world was expecting. Russia got bogged down, and the range of uncertainties increased again. Prices went down. Last night, Zelensky comes out and says, well, NATO membership, it doesn't have to be. We don't have to be in NATO. And uncertainty reduced, right? And prices started to rise. So, and I really think that this is what we're bringing with RiskSmith to, the rest of the world now, right? The rest of the investing world besides the institutional and professional
finally bringing
Markowitz's
Markowitz's work into light for retail investors. Yeah.
So I think this is a cool way to understand it.
Yeah.
And the core idea again, that the amount of possible paths the future could take, reduces the value of any individual path.
Right. And so the more risk, you can take the value of each path and you can discount it by the width of the risk, basically. Right. And so the more, exactly.
So let's get back to our histograms. you know, and if we go just look at some individual histograms, I was writing about this one today. Let me see if I can pull it up in here. Yeah, Berkshire. Okay. This is a little Schadenfreude. Schadenfreude, I don't know how you pronounce it, but
Yeah.
you know, it was not that long ago that Vlad Tenev of Robinhood was calling Charlie Munger of Berkshire Hathaway elitist and disappointing.
Do a dot A. That's actually got a dot in the symbol there.
Okay, got the wrong ticker in here.
It's all good. It's BRK.A.
There we go.
Yep.
So here's Berkshire Hathaway, right?
Yeah.
This is a pretty tight histogram.
Yeah.
In times of increasing uncertainty, you know, the stability of this asset is more highly valued.
Right. It's worth more.
Worth more,
yep.
Right?
Yep.
Meanwhile, if we go look at the histogram for Hood over the past year, and I think it was about a year since Vlad tried to take down Charlie Munger. I mean, how dumb can you be, right?
Yeah.
Here's Robinhood's histogram.
Right.
And,
this is really
you know, they're down 65%.
Right. Yeah.
And their D score is 8.4% today.
Incredible.
You know, well, so let's go
incredible.
back and look at Berkshire one more time. Meanwhile, Berkshire's up 22% with a D score of 1.4.
1.38. Right. I mean, so come on. Right. This is night and day comparison. And it's such a great example of like what risk does to price, right? This is when we talk about risk, right? Risk is probability of loss. Essentially, that's all risk is probability of loss. But like essentially, like you can think about risk mathematically as impacting value like this. It's not just this mythical thing like maybe it'll happen, maybe it won't. It can be mathematically modeled and you can see it. And right here is the proof in the pudding. Yeah. This is literally looking mathematically at how risk affects price.
Yep. Absolutely. So meanwhile, you know, what's going on in markets? So I made this portfolio. I just took the different sector ETFs of the S&P 500, materials, technology, real estate, financials. And I threw in a few things like gold, oil, USO, Bitcoin. Whoops. Didn't mean to go there. Go back. Not sure what I did there. Sometimes these Mac touchpads.
Yeah. Minds
have a mind of their own.
Yes.
And I thought we could look at the covariance matrix.
Yep. Great.
Of course, this is over, you know, the past year, right?
Yep.
But we can see that, well, gold has been pretty nicely minimally correlated to most sectors, right? And Bitcoin has been pretty nicely uncorrelated, right?
Yeah, it really has. Yep. Probably because of its volatility.
Yep. And, you know, so I thought we could just go explore some of these individually as well.
Yeah.
And the way that I still tend to do it, Justin, until we get a few modifications here, is I just go down and look at one asset. I know we can go to these single stock landers, but they don't have all the details.
We don't have all the charts on there yet. Yep.
So, you know, this is the materials.
Great.
In fact, let me open up another window here. By the way, another great example of the relationship between uncertainty and price are the Bitcoin, you know, the crypto regulations that everybody was concerned about, right?
Yep.
Again, increased uncertainty, what's going to happen, right?
Yep.
And then the executive order comes out. Oh, phew. Okay, no big changes.
Yep.
Reduced uncertainty.
Yep.
Price rises 10% in a day.
Yep. Now the question is, does the uncertainty remain gone, or does new uncertainty creep up about the next step? So that's there's always another question, right?
But the main point I'm trying to make is that uncertainty impacts price.
And it's scientifically shown. Absolutely.
Yes. All right, so we'll keep this up on this screen. XLB. Okay, this is the materials.
Yep.
The risk efficiency of XLB has been going down.
Yep. So it's been getting
so it means that
riskier.
It's had bigger losses relative to its gains.
Yep.
For quite a while now.
Mm-hmm.
Right? Its D score has been going up a bit.
Mm-hmm. Yep.
And its volatility has been going up, right?
Mm-hmm.
Standard deviation's going up, volatility's going up.
Yep. Yep.
Not a great looking sector.
Nope.
All right.
Do we know why that is? Can we explain that? Like, do we have an insight about that?
I don't have an insight about XLB and materials right now. I actually don't really know what companies are in that sector.
Yep.
So
I'm not sure myself.
It's not one I've been that focused on.
Yep.
But let's look at another one. So if we go back here, next one, XLK.
And that's another thing that it's another great point that even you can look at assets like this, right? Even if you don't know what the company is or what it does, right? And you can without really being able to understand the fundamentals of the companies or what that sector should be doing, you can immediately see how risky it is and what the dispersion outcomes looks like, right? Like you can immediately get a feel for what's happening in that sector.
Yeah. So here's XLK, which is technology.
Yep.
Definitely have seen increasing volatility.
Absolutely.
The standard deviation,
kind of a low in November, like right at that last week, October, November, and then it just zounk right back up with the standard deviation.
And growth from about the same time, has been, well, actually the standard deviation started to turn up before the growth really started to deteriorate.
Mm-hmm. So, started to get frothy, and then the frothiness led to, that's one of those things you could look back and you could say, this thing started to get more and more volatile, right? The prices kept going up and up and up.
And look at the risk efficiency, right? Peaked in late October.
Yeah, and everybody got real hot and heavy, and then it sort of it just got too much.
Growth didn't start declining until really January.
Mm-hmm.
So that's called a divergence. And if we go look at technology,
it's
a lot of green there.
Really pretty highly correlated with the rest of them. Yep.
And have to say that risk efficiency is still on the decline. Overall. Maybe that's a bit of a double bottom there. We'll see. Right. I have seen that. I was just reading on another site, Sentiment Trader. There's been a lot of insider buying in the technology sector. Unusual amounts of insider buying. So the insiders are optimistic that the future of technology is still bright, and I'm sure it is, right?
Yep.
And again, it's all about what's your time horizon.
Yep.
But pretty interesting what's going on in technology. All right, next one is real estate. Real estate's looking pretty good.
Yep, sure
Got
is.
a better risk efficiency, lower D score.
Makes sense. Real estate all over the place has been, there was a drop that kind of went with the general market drop, right?
Mm-hmm.
And this is something that I would love to explore at some point, maybe in a future chat that we have. I don't think it's right for today, but kind of talking a little bit about, there are two kinds of risks in the market. There's systemic risk, which is kind of the general risk that is just out there that's baked into the world, right?
Mm-hmm.
And then there's unsystemic risk, right? Which is risk that is unique to a position or a portfolio or a sector or a thing like that is not necessarily sort of general market level risk.
Mm-hmm.
And I have noticed personally, I would like to at some point explore. I think you can kind of see where, risk, you can see these big moves where you can tell that systemic risk just kind of increases risk for everything, but some things respond to it. Like some things can buffer themselves against that systemic risk, right? As the whole world gets riskier, each one of these gets riskier. That's why the risk efficiency for real estate still went down at the beginning of the year, but it's able to sort of buffer itself back up against what is right now a continuing decline in risk efficiency in the markets at large, which is an interesting pattern.
Yeah, I think one of the big trends is more value on real assets and less value on financial assets.
Mm-hmm.
And real estate, is a real asset, right?
Yeah.
Earnings, future earnings are a financial asset. Okay,
Mm-hmm.
so technology companies, are valued on their future earnings, and that gets, a little less valuable in increasing uncertainty and also with inflation, for sure.
Mm-hmm.
All right, so growth, real estate's been growing nicely. Volatility certainly picked up a little bit, but overall, the gains in real estate have been started to outpace the up days have been outpacing the down days. That's really what risk efficiency is. Are you having more up than down?
Yeah, over the long haul, in the aggregate, over your time horizon.
A year, right?
Yep.
So interesting, real estate perking up. See, pretty minimally correlated to gold.
Yeah.
What else? Oil, energy. Interesting. All right, next, XLF, financials.
Yeah. By the way, if anybody out there is listening and watching as we're going through these tickers and talking about what we're seeing here, and you have any questions, definitely chime in on the live chat there in YouTube. We'd love to chat with you about what's going on. If you have specific questions about what's happening in the markets, you want to talk about anything there, let us know. We'd love to hear about it.
Financials, pretty low risk efficiency.
Yep.
And higher D score.
Yeah. Yeah. It's really fascinating. You can immediately see where the risk is in the market and where the risks are not in the market, or where there's always risks,
where there's more risk is declining, less. Right?
Yeah, right.
Where the risk efficiency is declining. We can't necessarily say it's more risky or less risky, but the risk efficiency is declining. The ability of this asset to turn risk into reward is deteriorating. And, we certainly see the volatility picking up. We see growth declining, right?
Yep.
And actually, that was the D score picking up. So, but the standard deviation, volatility are increasing. Mm-hmm. Growth is declining. That's the opposite of risk efficiency. It's risk deficiency, inefficiency.
Right.
And so financials haven't gotten up off the mat.
No.
And don't think they're going to be a whole lot of help. It's interesting, how highly correlated they are to materials. I have to understand more what's in materials. I would have thought materials would be like Alcoa, right? And meanwhile, Alcoa's been soaring. So I'm that's a little mysterious to me. Maybe you can look into that on the side. What's in materials? See if I can
find some info on that, and I'm gonna look it up and I'll get back to you. Yep.
All right, XLP. Let's go take a look at that one. Consumer staples. Probably doing pretty well.
Yep.
A lot of pricing power in consumer staples, right?
Doing really well.
Interesting. Pretty bad day must have been day before. It must have been yesterday.
Yep.
Right. In what would be the tail. That's a tail event for consumer staples yesterday.
Yep. Yep.
Whoa. Risk efficiency on the rise.
It is essentially has an inverse risk efficiency trend to what the markets have done in general.
Yeah.
It's a great hedge against the markets in terms of risk efficiency.
Yeah.
Yeah. Interesting.
Holding pretty stable overall.
Yep.
Growth while everybody else has been declining, but starting to
cool off a little bit.
Interesting, the more recent volatility and rise in standard deviation. Mm-hmm. So been doing pretty well, but could be topping a little bit in risk efficiency. But
starting to lose its edge a little bit in terms of how efficient it is.
Yep.
Getting more noise in the signal.
If we compare it against, say, the S&P 500,
Yeah.
Interesting, because it, wasn't that uncorrelated here, right?
That is fascinating. And
then
it
really
changed its relationship.
2021 became more of a haven.
This is an amazing example of how predicting the markets is kind of a fool's errand, because you would have looked at this all of last year and expected that was probably going to follow it. I mean, it would have been a real controversial take in December to say that it was going to continue going up as the markets crashed. And yet here we are.
All right, let's take a look at oil, USO. That's gonna, it's got, pretty wide spread, right? Got some fat tails there.
Wow.
5% up and down days, not irregular. And you see that in the higher D score, 3.13%.
Yep.
Risk efficiency, 2.8, right?
Yep.
And I'm sure it's been on the rise, right? Really on the rise since Ukraine started, the end of February.
Yep.
Whew.
I mean, this is an interesting asset.
And volatility.
Yeah. I mean, it is volatile
for sure.
Man.
It's more volatile, but it's delivering more rewards than risk.
Every time you get smacked in the face, it's coming back with a bigger kiss.
I love it. What a graphic way to put it. All right. Well, let's just check a few more of these. XLY. Consumer discretionary versus instead of consumer staples, right? So not surprisingly,
inflation
not as risk efficient, right? It's discretionary in times of uncertainty. Discretionary things become less attractive than the staples.
Yep, absolutely. Wow, it's basically flat for the year.
And look at that volatility really picking up.
Yeah.
If we go back, it's interesting. Like XL Real Estate was one of the best ones, and XLP. So you might be looking and thinking, well, okay, what is real estate uncorrelated to, or more minimally correlated to, right? Oil, gold. I bet if we added XLRE to our portfolio that we made 2 weeks ago, which, by the way, has been doing pretty darn well.
Has it?
We should look at it.
Yeah, well, let's take a look at that.
I don't want to go too much longer. I don't want to keep people
wear everybody out
from the end of the day and wear everybody out. But hopefully this is at least giving, directionally an idea of how to use these tools and how to think about markets, and especially to start to understand the relationship between, dispersion of possible outcomes or risk, uncertainty, and price, right?
Yeah.
All right. So that was XLY we were just looking at, which is
because we don't know what's going to happen, right? with the Russia-Ukraine thing, we don't know what's going to happen. We have no idea. We cannot tell what's going to happen tomorrow. We don't know what's going to happen in a week. But what we do know is the range of uncertainty that's happening any given day.
Kind of expand and contract.
Yeah, and that is what you can use to look at the markets and start to understand, like, why are things moving the way they are? Looking at it through the lens of uncertainty helps to start explain these movements a little bit better.
Yeah. So energy, obviously, been doing pretty well. Overall, the energy sector has a little lower D score than oil by itself.
Yeah.
A little less risk efficient right now, but less growth.
Mm-hmm.
So overall, like oil, a little better than energy.
Yep.
But look at that's interesting that the standard deviation has been coming down so much. And we haven't seen a whole lot of increase in volatility there.
Right. Yeah, it's really not getting more volatile.
Well, and you see it, right? Growth is up and volatility's not.
Right, which means that this thing might have a higher value.
More risk efficient.
Like it's increasing its own value. As it goes. And one thing that's interesting, and again, we can't predict the future. We don't know what's happening here. But one thing that's interesting to look at is just, that the volatility measure, the D score measure, which is really the measure of the width of that hurricane cone of uncertainty, it doesn't usually change dramatically quickly. It doesn't overnight, typically, as I've seen. I haven't seen it to where it's moved in portfolios, single assets, or sectors like this. It moves relatively gradually. It has some weight to it, right? And so, not that it can predict which way it's going to go tomorrow, but this number tends to be sluggish in terms of how it moves. Volatility doesn't just come out of nowhere tomorrow, right? It's sort of
not usually
ebbs and flows. Not usually, unless there's some black swan event.
Right.
Yeah. Right.
So here's utilities.
Yep.
Pretty tight histogram. Does get out to a 3% day.
Yep.
Certainly been on the rise, since a lot of the things that everybody else was in started declining.
Yep.
Had some good growth. A little increasing volatility lately, but overall, standard deviation going down.
Yeah.
So interesting, utilities doing good and not very volatile, right? They have a low D score, 1.54. Might be worth looking at utilities as an addition.
Mm-hmm.
All right.
So XLB, I was going to mention XLB. I looked up some of the holdings of XLB, some of the top holdings, and they're all materials companies that are doing a lot of mining, copper mining, oil, not oil, but copper mining, and Sherwin-Williams is in there, Lind PLC, Freeport McMoran. McMoran, thank you. Newmont, Ecolab, Dow, DuPont. So these are the guys in there. And I was thinking, like, what is the relationship to finance here? Well, I'll bet you, like, a lot of those folks have expensive operations. They probably tend to, maybe they rely on a lot of capital, or I don't know why it's so tightly correlated with the financial markets. I'm trying to come up with a theory about that.
That's all right.
Yeah, I don't really know.
not our main focus.
It's not.
All right. So industrials.
Yep.
Not too great. Risk efficiency on the decline still. Not delivering the growth for the risks taken. Not interested.
No.
And last but not least, XLV. Healthcare. Could be interesting.
That will be interesting.
All right.
1.4
risk efficiency. Pretty good. And a pretty low D score.
Yeah.
1.4%. So, definitely not in decline on the risk efficiency. D score's gone up a bit, but nothing terrible.
Yep.
Modest gains. Not big declines from December, when everybody else started falling out of bed. And, the volatility hasn't picked up dramatically in healthcare.
No.
So out of these different sectors, I'd say healthcare, real estate, and consumer staples, I think, which I think was XLP.
And U.S. oil.
And USO, of course.
While volatile, has been producing nice rewards for each pound of risk.
So here's the portfolio you and I built a couple weeks ago.
Yeah.
And
you're holding strong?
It's holding strong. I mean, 2 weeks was about there.
Yeah.
Right? So kind of hard to see, but
yeah,
definitely has not been declining, in the way that the market as a whole has, let alone, the NASDAQ, right? And I mean, there was a day when Alcoa was up 10%, you know? But let's see if we can make it even better by adding some of these assets that are being more risk efficient and not as correlated. So XLRE, for example.
Yeah.
Boom.
Excellent. That was easy.
Raise the risk efficiency.
Drop the D score.
XLRE, XL risk efficiency. XL risk efficient.
I love it.
So.
Yep.
And
what about USO?
Yeah. Okay. Sure.
No, say what you're going to say though.
I would just say that, we talked in the beginning about how 70 years ago, Markowitz showed the world that, uncertainty, the range of possible outcomes has a cost.
Yep.
Right. And, that's certainly true of markets as a whole, but it's true for us psychologically as well. Right.
Yep.
And so what having a risk efficient portfolio does for us, and a lower D score is it tightens up. The lower D score is basically tightening up how much pain, you're going to have to put up with.
Yep.
Right. And maybe you can put up with a lot of pain. Maybe you can't. Different people have different risk tolerances depending on where they're at in life, how much money they've got invested, et cetera. Right. But, that's what the D score is telling us. You can have a narrower range of daily experiences in your portfolio, right? And that has a sleep benefit for us, right?
Absolutely.
That you can sleep at night.
It has an
and that
entire
matters.
quality of life benefit. Yes.
It's a quality of life thing.
Yes, absolutely is.
So.
And it will make you a better investor because you will not fall prey to the behavioral traps that volatility will get into.
Yeah.
Because you want so much to have certainty, and we hate uncertainty so much that we respond actually, irrationally, kind of, or rationally, I'm not sure, but we respond to events that are uncertain in a way that we don't have to respond that way if we'd already known that it was inside of the range of outcomes, right? If a hurricane hits you and you're in Florida, you can't be surprised when you were in the cone for 5 days, right? You can't just look up and go, why is there a hurricane here? I mean, it was in the range of outcomes. But if you're in Maine and that happens, wow.
This is USO.
What'd you add? Oh,
USO.
You added
USO, right?
Love it.
You know what I really love about this, Justin, too, is that, a lot of people are looking at oil today and going, oh, it's gone too far too fast, right?
Yep.
This doesn't factor that in at all, right?
No.
This is this is a good complement to this existing portfolio, right?
Right.
And you're not going all in on oil. What is this? USO is 6% of this portfolio,
right.
On a volatility weighted basis, right?
Yep.
But let's look at the covariance matrix and see, if we add USO, here it is right here.
Man.
0.1 with Bitcoin, 0.0 with Atlassian, 0.15 with AbbVie, 0.3 with Alcoa, not surprisingly. Little negative with Procter and Gamble. almost nothing with Mongo,
Mhm.
pretty low with
Makes
Ford,
sense.
a little more with greens. But look at how, man,
Over the
I'd add this to this
overall,
portfolio in a heartbeat. In fact, I think
absolutely,
we'll
I
keep it
would
in
do
there.
it immediately. Yep, absolutely. I love it.
Whoops.
I love it.
All right. Well, I think we covered some good ground today. Gave
Yep.
people an idea of a little more insight about how markets work, right? I guess I just would like to close with this. This is Markowitz's paper from 1952, right? And I just want to read these opening sentences. The process of selecting a portfolio may be divided into two stages. The first stage starts with observation and experience and ends with beliefs about the future performances of available securities, right? So we do have to have, informed opinions, informed beliefs about markets, or we have to rely on somebody else to do that, right?
Yep.
So, I've talked a lot about Dalio's Holy Grail portfolio philosophy. You got to have good, uncorrelated, right? Good, uncorrelated. Those are different things, right? So you do have to have a belief about good, and it's got to be informed, or you have to follow somebody else who's got, a good track record of good beliefs that have panned out, right? The second stage starts with the relevant beliefs about future performances, right? That's based on history. And ends with the choice of portfolio, right? This paper is concerned with the second stage. So, that's the portfolio construction process. That's the process of having a forecast about the future and looking at kind of the dispersion of possible outcomes there, trying to narrow that by having uncorrelated assets. So that's what we're building. People are using it. They're appreciating it. We got more to do. We got work to do for sure, but I'm thrilled with how I see people interacting with it, how it's just by using it, it's changing the way they think about investing, which is exactly what Markowitz did for, sophisticated investors 70 years ago, right? And it's high time that this true financial technology, this is financial technology.
Yeah.
Right?
Yeah. That's right.
And and more people need access to this.
Yeah. So tell your friends, if you're watching and you are a user, tell your friends. They can sign up for free at RiskSmith.com. And if you're watching this and you're not a user, then go sign up for free at RiskSmith.com. It doesn't cost anything. Go get in there. What are you doing? Stop. Awesome. Go make a portfolio.
All right. Thanks, Justin.
Awesome.
Been fun.
Enjoyed it. A really insightful little bit and a great chat. Really enjoyed looking at all of that. Looking forward to doing